All right, let's get right into it. The term financial risk sounds super serious, right? It probably brings up images of Wall Street traders yelling into phones and complicated charts with lines going everywhere. But here's the thing. You deal with risk every single day, and you're probably better at managing it than you think. Imagine you're learning to skateboard for the first time. You know there's a chance you could fall and scrape your knee. That possibility of falling? That's risk. To make it less likely, you might put on protective gear, wear a helmet, wear knee pads. You're not eliminating the risk entirely, but you're managing it so you can still have fun and, hopefully, not end up with a big medical bill. Financial risk is pretty much the same idea, just with your money instead of your knees. Think about it like this. You're planning a big outdoor picnic. You check the weather forecast. 30% chance of rain. You have a choice. You could cancel the picnic, 0 risk of getting wet, 0 fun, or you could go ahead and hope for the best, a bit of a gamble. The smart move? Bring an umbrella and have a backup location planned. You've acknowledged the risk, the rain, and taken simple steps so your day isn't ruined. Every financial decision, saving for a vacation, buying a house, has a little bit of that chance of rain built into it. The goal isn't to avoid cloudy days forever. It's to remember to pack an umbrella. So, let's put a simple definition on this. Financial risk is the possibility that you could lose money or not make as much money as you expected. That's it. It's the uncertainty tied to any decision involving your finances. When you put your money into something, stocks, a new business idea, or a high-yield savings account, there's no absolute 100% guarantee of what the outcome will be. That uncertainty, that gap between what you hope will happen and what could actually happen, is where financial risk lives. It's the what-if factor of your money. Let's look at a real-life example. Say you decide to invest $1,000 in a popular tech company's stock. You're hoping the company does well, and your stock value goes up to $1,200. That's your expected outcome. However, there's a risk that a new competitor could emerge, or the company could release a failed product. Your stock value might drop to $800 instead. That potential for loss is the financial risk you accepted when you bought the stock. On the flip side, keeping that $1,000 in cash under your mattress has its own risk. The risk of inflation, where your money loses purchasing power over time. So, you see, risk is almost impossible to avoid completely. Another great example is starting a small business. Okay, so we know what risk is. But why should you, an average person just trying to pay your bills and maybe save a little, actually care about this? The answer is simple. Understanding financial risk is one of the most powerful tools you have for building a better financial future. It's the difference between making money decisions with your eyes closed and making them with a clear map of the road ahead. When you understand the risks involved, you can make smarter, more confident choices. You're no longer just guessing or following a friend's hot tip. You're actively steering your own financial ship. Buy a house one day, retire comfortably, travel the world, pay for your kids' college education. None of these things happen by accident. They require planning, saving, and investing your money so it can grow over time. Every single one of those goals involves taking on some level of financial risk. If you want to grow your money faster than inflation, you'll likely need to invest it. And investing comes with risk. By understanding that risk, you can choose investments that match your timeline and your comfort level, massively increasing your chances of actually reaching those goals. Here's another reason this matters in your daily life: avoiding scams and bad financial products. The world is full of people and companies promising guaranteed high returns with 0 risk. Spoiler alert, that's not a real thing. Understanding risk helps you ask the right questions. What's the catch? What are the potential downsides? How could I lose money here? This critical thinking can protect you from devastating losses and predatory schemes. Ultimately, learning about financial risk empowers you. It takes the fear and mystery out of managing your money. So you're ready to be a risk manager. Great. The next step: financial risk isn't one big monster. It's a bunch of smaller, manageable creatures. We'll break down the most common ones. Market risk. The big one most people think of. Risk that the entire market can go down, stocks or real estate, taking your investment with it. Even if the company you picked is doing great, the market can pull everything down. Think 2008. Think early 2020. Sometimes everything falls together, like a rainstorm soaking everyone at a picnic. Credit risk. Super simple. Someone who owes you money might not pay you back. Lend a friend $100, they might not repay. Buy a corporate bond. You're lending a company that could go bankrupt. That company could go bankrupt and not pay you back. Lenders check credit scores to measure this risk. It's the "will I get my money back?" risk, and also personal liquidity and operational risks. Liquidity risk. You need cash fast, but your money is tied up in illiquid assets like a house, asset rich, cash poor. Operational or personal risks, job loss, medical emergency, or car breakdown, impact your cash flow and emergency fund needs. These affect your cash flow, so keep an emergency fund. Inflation risk, the silent money eater. Cash today buys less tomorrow. If inflation is 3% and your savings earn 0.5%, you lose 2.5% purchasing power each year. Your balance may look the same, but its real value shrinks. Hoarding cash long-term is risky. A good financial plan protects you from multiple angles, not just a stock market crash. Market, credit, liquidity, inflation, these are all manageable if you understand them. Next, how to protect your hard-earned money. Okay, we've identified the risks. Now for the most important part. What do you actually do about it? How do you protect your money? The single most powerful strategy is diversification. Please, do not put all your eggs in one basket. It's the oldest advice in the book for a reason. By spreading your money across stocks, bonds, and real estate, you reduce the impact if one performs poorly. If your tech stocks have a bad year, maybe your real estate holdings or international stocks will have a good one, balancing things out. It's the financial equivalent of bringing both an umbrella and sunscreen to the picnic. Your second best friend in managing risk is time. The longer you're invested, the more risk you can generally afford to take. If you're 25 saving for retirement in 40 years, a market crash is a temporary dip. If you're 64 needing money next year, you can't afford that level of risk. Next up, and this is non-negotiable, is building an emergency fund. This is your personal risk shield. Typically 3 to 6 months of essential expenses kept in a separate, easily accessible savings account. When your car's transmission dies or you have an unexpected medical bill, you can pull from this fund instead of going into debt. You avoid being forced to sell your investments at the worst possible time. Finally, automate your finances. Set up automatic transfers to savings, retirement, and investment accounts every payday. This helps in 2 ways. It ensures you're consistently investing, and it smooths out your purchase price over time. This is called dollar cost averaging. You buy whether the market is high or low, smoothing your average purchase price. Automation removes emotion, protecting you from panic sells and impulsive overbuys. Your plan runs on autopilot and keeps you on track. These simple steps, diversify, use time, build an emergency fund, and automate, are the core of protecting your money. They give you a buffer against panic and poor choices and help you sleep better at night. At the end of the day, all these tips and strategies boil down to one secret weapon that's more powerful than anything else: knowledge. The more you learn about personal finance, the less scary it becomes. Risk isn't something to be terrified of. It's something to be understood and managed. Think of it like learning to swim. At first, the deep end is terrifying. Take lessons, practice your strokes, learn how to float. You gain confidence. You understand the water's properties and your own abilities. The same is true for your money. Learning the basics of budgeting, saving, and investing builds confidence. You don't need a degree. Small, consistent steps add up. Watch trusted creators, read a few well-regarded books, listen to podcasts on your commute. Learn to budget, save a little each month, and invest regularly. Every little bit you learn chips away at fear and replaces it with confidence. You start to see financial risk not as a threat, but as a trade-off you can control and use to your advantage. When the market has a bad week, you won't panic sell because you understand fluctuations are normal. And when a too-good-to-be-true opportunity appears, your knowledge will be the red flag that protects you. You become the calm, rational captain of your financial ship, able to navigate storms because you've studied the maps. So my final message: don't let fear paralyze you. Embrace the opportunity to learn. Start small, stay curious, be patient with yourself. What risk is, why it matters, how to manage it. You are building a future where you are in control and where your money is working for you. Pursue your biggest goals with confidence and peace of mind. That feeling of empowerment is the ultimate return on your investment in knowledge.